Welcome to The Explainer. Today, we're going to unravel something really strange that's been happening in the silver market, something that caught a lot of people completely off guard. It's a story about two different prices for the exact same metal that started moving in opposite directions. And what that tells us? Well, it reveals a hidden market just under the surface.
Okay, so let's dive right into the central mystery here. Just imagine this. You're watching the financial news, and you see that the price of silver is dropping. You think, hey, maybe this is a good time to buy. So you head down to your local coin dealer. But when you get there, the price they quote you is suddenly 30, 40, even 50% higher than it was just a little while ago. How in the world is that possible? What's going on here?
And this really shows you the paradox we're talking about. On the left, you've got that official spot price, the one you see on TV, and it's clearly heading down. But look at the right. The actual price you'd pay at the counter for physical silver went the other way. It shot straight up. Now, these two lines are supposed to move together, but as you can see, they completely disconnected. Now, your first reaction, and it's a natural one, might be to think the dealers were just taking advantage of the situation, price gouging. But the analysis we're digging into today suggests that's not what was happening at all. The real story, well, it goes a lot deeper. And it started in a part of the supply chain that most of us never ever see. So to really get to the bottom of this, we have to understand a crucial concept. We're not actually talking about one market for silver. We're talking about two very different markets. And this distinction, well, it's at the very heart of the entire puzzle. First up, let's talk about that spot price. That's the price flashing on the screen, right? But here's the catch. That price isn't for the metal itself. It's for a paper contract. It's basically a promise to deliver metal at some point in the future. And most of these contracts are just settled for cash. No actual physical silver ever changes hands. But then you have the physical price, and that's a whole different ballgame. This is the price to actually get your hands on the real, tangible metal. This isn't a market of paper promises. It's a market based on what's actually available. It's the cost to own a real asset, and it plays by its own set of rules. Okay, so if you've got these two separate markets, what on earth could cause the price of real physical metal to just explode upwards while the paper price was falling? Well, the analysis points to a crisis that was happening far away from the public eye, deep inside the supply chain. And this quote right here, it really nails it. That crazy price jump you saw at the dealer, that wasn't the start of the problem. That was the final symptom. Long before you even walked into that shop, the big wholesalers and refiners that supply the dealers, they had already lost their access to affordable metal. The problem had already taken root. This chart shows you the typical journey silver takes to get to you. But what this analysis shows is that the breakdown happened way upstream, right there between the big refiners and the wholesalers. A massive bottleneck formed, and by the time we felt the effects down at the local dealer level, the crisis was already in full swing. And the proof wasn't just in the prices. You started seeing all these other strange signals. Wholesalers were suddenly demanding much larger minimum orders. If you called a refiner, they might just say, try again next week, with no firm dates. The big, efficient 1,000-ounce bars just disappeared. These are all textbook signs that the actual supply of the metal is in serious trouble. So what this all really means is that if you were just watching that spot price on a chart, you were looking at the wrong thing. You were completely missing the real story because the most important signals had absolutely nothing to do with that paper price. The key takeaway here is this. In a stressed market, the real indicators are all about access. The real questions you had to ask were, can you still get the metal? Are the premiums, the extra costs on top of spot, going through the roof? Are delivery times getting longer and longer? Those were the true signals of what was happening, not some number flickering on a computer screen. By the way, if you're finding this explainer useful, please take a moment to like, share, and subscribe. That way we can keep bringing you clear analyses just like this one. So what does it all mean when the paper market screams that the price is dropping, but the physical market, the one for real metal, completely ignores it and goes in the opposite direction? This is where the story gets really fascinating. The difference here is just night and day. On one hand, here's what should have happened, according to the textbooks. When the spot price fell, dealers should have lowered their prices, and people holding silver should have been tempted to sell. But that's not what happened. The reality was, dealers kept their prices high, the folks who owned physical silver refused to sell a single ounce, and industrial users just kept on buying. The physical market just flat out refused to follow the paper market down. And this leads us to a really powerful idea from the source material. This event wasn't just some temporary glitch in the system.
It was a fundamental reset. It was the moment the physical market really showed its underlying strength and basically said, we're not tied to that paper price anymore. So the conclusion here is that all the pressure that caused this big squeeze, it hasn't gone away. In fact, it might be building. Think about it. Industrial demand for silver is constant, governments are quietly accumulating it, and the people who held on through that price drop are now even less likely to sell. Those supply chain problems, they don't just fix themselves overnight.
And that leaves us with this final, really thought-provoking question. The paper market tried to push the price down, likely to shake some physical metal loose from owners, and it failed. So, what happens next? What happens when the market truly needs those physical ounces, and the people who hold them simply refuse to sell? According to this analysis, that is the big question that now hangs over the entire silver market.